Not many companies can move markets the way Oracle just did. In a single trading day, the stock rocketed as much as 43%, its biggest leap since 1992. And for a brief moment, it pushed Larry Ellison, its founder, past Elon Musk to the top of the global wealth rankings. That company isn't a startup, a GPU vendor, or a consumer app. It's Oracle, suddenly at the center of the AI supercycle. Overnight, Oracle stopped being the database company and became a frontline supplier to the AI infrastructure. Why the market has re-rated its future, what the numbers really say, where the risks lurk, and how new mega contracts with OpenAI and TikTok agreement could shape the next decade. By the end, you'll know exactly what changed and what has to go right next for this re-rating to hold. Welcome back to the Capital Navigator, the channel where we explore the history, strategies, and business models of the world's most influential companies. Today, we're talking about Oracle, a true pioneer in the enterprise software space. For years, Oracle was the undisputed leader in on-premise databases, a profitable but slow-growth business. However, the company has successfully navigated the shift to the cloud, and its recent financial results and partnerships with AI leaders have completely reshaped its market perception. Let's begin. Origins, the long road to reinvention. Oracle's story starts in June 1977, when Larry Ellison, Bob Miner, and Ed Oates put $2,000 into a tiny outfit called Software Development Laboratories in Santa Clara. Their inspiration? A research paper out of IBM on relational databases, an idea Big Blue didn't commercialize, but Ellison would. Early on, SDL won a contract from the CIA. The codename was Oracle. The project finished ahead of schedule and lent its name to the product, and later, the company. In 1979, Oracle shipped V2, the first commercial SQL relational database management system. By 1986, it went public. By 1987, it was the largest database company in the world. The 2000s were an M&A blitz. PeopleSoft, Siebel, BEA, and Sun Microsystems, which brought Java, Solaris, bulking up across HR, CRM, middleware, and then hardware. That set the stage for a new act, cloud. Oracle launched its public cloud, pushed managed autonomous database, self-managing, self-securing, self-repairing, and by 2025, began marketing the Oracle AI database that bakes vector search and LLM connectivity directly into the data layer. The long arc, from databases that store the world's transactions to infrastructure that will run the world's models, bridging firms' private information with models like Gemini, ChatGPT, or Grok. The business model now. Today, Oracle organizes around cloud and software, hardware and services, a model transformed from perpetual on-premises licenses to subscriptions across IaaS, PaaS, and SaaS. This shift is the engine of the company's reinvention. Cloud and software, the growth driver, covers Oracle Cloud subscriptions and both cloud and on-premises licenses in different modalities. Oracle Cloud Infrastructure delivers compute, storage, and networking. Oracle stresses high performance at lower cost, especially for AI clusters. In platform-as-a-service offerings, underpins developers, now including the Oracle AI database with vectors and LLM connectivity, and also its traditional business of selling software licenses like CRM, HR, NetSuite, all on a shared data model meant to reduce integration friction. Hardware supplies engineered systems, servers, storage, and related software. Smaller than cloud and software, but strategically relevant. And services, consulting and advanced customer support, help customers extract value from Oracle's stack. Together, this bundled, integrated approach amplifies switching costs and cross-sell potential, an idea we'll test when we talk moat and risks. Oracle's model gives them some advantages. Technology. Oracle's core technology, its relational database, is still a powerful competitive moat. The company has a massive installed base of customers who rely on its database for their mission-critical operations. Economies of scale. As a massive enterprise software company, Oracle benefits from immense economies of scale. Its vast global network of data centers, its immense R&D budget, and its worldwide sales team give it a significant advantage over smaller competitors. Integrated stack. Database plus infrastructure plus applications on one data model leads to governance and security advantages. With the Oracle AI database, search and LLM connectivity live in the database, so enterprises can query private data with large models without moving that data around, reducing risk and complexity. In regulated industries, that's not a feature, it's the reason a deal gets signed. The numbers: Oracle's revenue moved from $49 billion in fiscal year 2023 to $57 billion in fiscal year 2025, approximately 8% growth in the most recent year. Gross margin remained strong, but eased from 72% in 2023 to 70% in 2025. As mix shifted and as the company front-loaded cloud infrastructure. Operating margins are still near approximately 30%, down a touch as CapEx and people costs rise. Q1 2026 provides the tell. Revenue grew 12% to $14.9 billion. Operating margin landed at 29%, with the segment the Oracle Cloud Infrastructure growing 55% year over year. That's the growth engine delivering, even as OpEx swelled $1.3 billion from higher cloud infrastructure expense and stock-based compensation. The math is simple. Build now, absorb the hit, then scale utilization into the backlog. Cash and CapEx are the pressure points, with a negative free cash flow and a CapEx estimated around $25 billion for 2026. Investors are effectively funding the factories for the future. The headline metric for the quarter was the $455 billion remaining performance obligations, or RPO, an acronym not frequently heard, is a key financial metric representing the total value of future contracted revenues that Oracle has not yet recognized. Put simply, it's the company's backlog or order book, the total value of non-cancelable contracts it has signed with customers for which it will deliver products or services in the future. RPO is a fundamental indicator for assessing Oracle's business health and future visibility, especially during its shift toward a subscription-based and cloud services model. There was a 359% growth in this metric. It's easy to see why the market latched onto it despite the small miss on consensus revenue and EPS for Q1. The spike, 27% to 43% intraday, the biggest leap since 1992, briefly pushed Oracle's market cap toward $1 trillion and crowned Ellison the richest person alive for a few hours. If you want to understand the new Oracle, this is the pivot point. Valuation says the market buys the story. For now, the company flags a price-to-earnings multiple near 75, about 43% above Oracle's 5-year average of just 31. Enterprise value EBITDA is also elevated, approximately 39 versus a 5-year average of approximately 18. This is a demanding valuation. The multiple expanded as the market re-rated Oracle from mature software to AI infrastructure leader. Bulls say that's the price of growth. Skeptics say it bakes in perfection amid heavy CapEx and near-term negative FCF. The gap between backlog and cash is the bridge Oracle must cross, turning contracted obligations into revenue and revenue into cash. The AI pivot, a new narrative. Oracle grew up in the world of relational databases, SQL, transactions, uptime. Over time, it stacked on entire categories, enterprise apps in finance, HR, supply chain, customer experience, and then did something unusual. It started co-designing hardware and software together. That's where engineered systems like Exadata came from, blending database smarts with purpose-built hardware to move data faster. Then came the cloud era. Oracle's infrastructure as a service. Oracle Cloud Infrastructure promised high-performance compute, storage, and ultra-fast interconnects. Its platform as a service layer pushed the database into the cloud, culminating in the autonomous database that patches and tunes itself. On top, software as a service suites like Fusion and NetSuite gave enterprises modern apps tied to a unified data model. Oracle's update makes the database itself AI-ready. It now understands vector search and can talk directly to large language models. Practically, that means when someone asks an AI a question, the system looks up the answer inside the company's main database, the secure source of truth, without copying sensitive records into outside tools. The same permissions, security rules, and audit trails you already use for the database automatically apply to the AI. Because the lookup happens right next to where the data is stored, responses arrive faster. End result? AI stops being a demo and starts doing real work, closing the books, planning inventory, triaging patients, dispatching field teams, because it's wired into the core systems that run the business. Training and running AI models is a speed game. If the network that links the chips moves data faster, the job finishes sooner, and the total cost of that job drops. That's the whole pitch. If we're twice as fast, we're half the cost. For teams training big models or serving lots of AI answers every day, shaving hours and dollars off each run isn't a nice bonus. It's essential to staying competitive. New deals, OpenAI and TikTok. Lately, Oracle's been front and center in the news and on Wall Street, driven by a series of high-profile agreements. One of these deals is with OpenAI. They agreed to spend up to $300 billion over about 5 years on Oracle's cloud capacity, beginning around 2027, a cornerstone of Project Stargate. the planned infrastructure footprint underpinning OpenAI's long-term compute needs. Oracle's leadership credits a technical edge, building very large AI clusters that run faster and cheaper as the reason it won. This single relationship explains a huge portion of Oracle's backlog and a big part of the RPO growth number that makes the stock climb. This new identity, we sell capacity and energy, also explains why Oracle keeps expanding multi-cloud connections, wiring OCI to work with Azure, AWS, and Google Cloud, and why it plans to add 37 more data centers with partners. If AI demand is a flood, you want as many on-ramps and reservoirs as possible. The other big deal, TikTok, Oracle is also positioned in a potential TikTok US restructuring. Under a reported framework, a new US-dominated entity would operate TikTok's US business with a roughly 80% American investor stake and Chinese shareholders owning the rest.
TikTok's U.S. operations would be controlled by an investor consortium including Oracle, Silver Lake, and Andreessen Horowitz, under a framework the U.S. and China are finalizing, the Wall Street Journal reported on Tuesday, citing people familiar with the matter.
And besides that, Oracle would continue as the cloud provider, routing and storing all U.S. user data on OCI, effectively creating a firewall between U.S. operations and the Chinese parent. Its infrastructure as a policy tool, and Oracle at the control plane. The risks where the story can break. Let's flip the coin. Oracle fights in every arena: cloud infrastructure, enterprise apps, and databases against deeply capable rivals. There is a fierce competitive landscape from the major cloud providers, Amazon, Microsoft, and Google. These companies have a massive head start and have immense resources to invest in technology and marketing. Oracle was also a late entrant to cloud, so execution risk stays high. If the company misreads customer needs or stumbles on delivery, reputation and margins are on the line. Investors like the new Oracle narrative. Competitors would like to write the ending. Short term, the spend cycle matters. Operating expenses rose faster than cloud revenue in the cited period, contributing to a flat net income outcome and a dip in diluted EPS. That's the near-term tax for capacity building. If delivery slips or costs overshoot, the market will quickly ask whether growth is quality growth. And dependence on large AI customers can cut both ways. There are concerns about relying heavily on a not profitable OpenAI, including the possibility that if a marquee customer doesn't meet obligations, the ripple effects could be genuine. A demanding valuation, AP/E near 75, is not a wide margin for error number. The multiple is essentially an execution clause. Convert backlog into revenue, revenue into cash, and do it while maintaining the speed and cost edge that won the deals. Miss that, and multiples compress fast. The most surprising thing about Oracle's reinvention isn't the tech, it's the scope. A company that once defined the enterprise database now wants to define the capacity behind AI itself. That involves capital, contracts, and conviction. Spend billions now, deliver on hundreds of billions later. The next chapters hinge on installation schedules, real-world throughput, and the discipline to turn RPO into cash without losing the speed and cost edge that won the work. So, is Oracle overpromising, or has it simply been underestimated for a decade? If the performance story holds and the capacity arrives on time, this is what a classic tech incumbent looks like when it becomes an AI infrastructure utility. If not, the market's patience will evaporate as quickly as it appeared. If this helps, tap like and subscribe. Your sub genuinely helps the channel grow and enables more in-depth breakdowns like this. And if you know someone who'd appreciate a thoughtful business story, send it their way. See you in the next one.